Welcome to Metcalf Money Moment, the podcast. Unlock financial clarity and confidence with expert insights to achieve your goals. Hosted by Jeb Graham, Ethan Hutchison, and Eric Wymore. Each episode offers decades of combined expertise in wealth management, retirement planning, and more. Join us for practical strategies to inspire your financial journey. Now your hosts.
Welcome to Metcalf Money Moment podcast. My name is Jeb Graham. I have Eric Wymore and Ethan Hutchison, partners and also co-hosts here with me today. How we doing, guys?
Morning, guys.
Good morning. Doing well.
Good morning. So I think maybe today we could start with a little question that I would pose to you guys, the audience, anybody that wants to answer it to themselves. But so if you had the opportunity to buy the next Amazon, Apple, or Nvidia on the very first day that it became publicly traded, would you do it?
Is this a trick question?
Yeah, it could be. I don't know. Would you do it or wouldn't you?
I'm going to refrain from answering that question.
There you go. Well, I guess
fit.
I don't want to have to make you, but here's the deal. So almost everyone says yes, but history tells us that buying a great company on its IPO day often is not the best investment decision. So today what we're going to do is we're going to go through why that is. So, and I think this is a very timely topic right now because people have referred to this as the summer of IPOs, probably the biggest summer that we've had in IPOs or biggest year we've had in IPOs in a very long time. Everyone's talked about SpaceX that just obviously IPO'd a month ago. We have Anthropic and we have OpenAI that are slated to go public. So there's just a lot of talk about IPOs. And what I'll tell you is every few years we have these IPOs that basically these are great companies that everybody uses, everybody knows what they are, and everybody wants to be invested in, right? Or not everybody, but a lot of people do. So if you think about it, over the past, call it 10 years, you've had Facebook, Uber, Airbnb, Rivian, Twitter, or X. And I'll tell you what, every time we go through this as financial advisors, we have clients, and if I was a client, I would too, right? They call in and they say, hey, I want to be able to get in on this. This is a company I believe in. This is a company I use. And so, and I think there's a big thought process out there that this one's different, right? Like this one's going to IPO, it's going to go to the moon and it's never coming back. And I think what we want to do today is just kind of go through some, number one, stats of why that's not always true. And then also just kind of go through not necessarily what advice we give people around IPOs, but just a thought process to keep in mind around IPOs. But one interesting stat is that the average IPO goes up 19% on its first day of trading. Okay, so you think about that. SpaceX was a great example of that. It becomes public and immediately, because of all the public sentiment. So what this does is it creates tremendous excitement, makes investors feel like they missed out if they weren't allocated shares. So basically people keep buying in and then you see it go up significantly. But here's the part that doesn't always make the headlines, or it probably does make the headlines, but by this time people aren't even thinking about it anymore. They're not worried about it unless they're one of those people that bought it on the IPO day, right? Is that many major IPOs experience a very large drawdown during the first year. So one study found that the average maximum decline from peak to trough is 55% during that year. So think about that. The IPO comes out, it goes up 19% that very first day. And then sometime in this next year, it goes down 55% from that high, right? And then, and by the way, a lot of these companies became hugely successful after that. So we're not saying that owning the stock over time was a bad choice. We're just saying in general, the first year was a little bit bumpy for investors. So if we're going to look a little further out, nearly 2 out of every 3 IPOs underperform the broader market over the following 3 years. Okay, so you think about the broader market, S&P 500, 2 out of 3 IPOs underperform that over the following 3 years after their IPO. So the questions become is, why does this keep happening? Why do smart investors continue to chase IPOs? And is buying a great company automatically a great investment? So today we're going to kind of try to differentiate some of the excitement from the evidence. And we're going to start with Eric, just talking a little bit about history of IPOs and some stats around them.
Yeah, absolutely. So yeah, let's start with the basics. I mean, so an IPO, it's an initial public offering. So it's the first time that a privately owned company offer shares to the public through a stock exchange. Before that, usually the ownership is just limited to the founders, to maybe the employees or venture capitalist fund or some other private investor. So going public allows anybody with a brokerage account to be able to purchase that company, become a shareholder. The reason, why does a company want to go public? There's several reasons, but I think one of the biggest reasons is it gives them, gives them access to capital. So for example, the company is able to sell a portion of their company, and it raises quite a bit of cash. That's the one time the company actually receives the money. That's the only time that the company actually receives money for a sale of the stock. They might take that money to, pay down debt, to acquire a different company, to reinvest it into research and development. A number of different reasons why a company will want access to capital, and it's a good opportunity for them to do that. And you're going to go back into that excitement, and what Wall Street is doing, and they're creating that excitement because they have a series of underwriters or big investment banks that go around and do kind of a dog and pony show and explain to every investor, every institutional investor, why this is the next greatest company that they need to put their money into, and it drives that price up, and that creates that that excitement. And so when it's time to go public, usually there's a little bit of a cooked in, little extra capital that the company can receive. One thing about an IPO, or initial public offering, is the retail investor, the individual investor, which is us and our clients and most of our clients. It's really difficult for us to get into the IPO, the actual initial public offering, and the reason is because those investment banks will take the show on the road to larger clients, institutional funds, big investors, and by the time it gets all the way trickled down to the individual investor, that means that some of those large investors, institutional investors, decide to pass on that IPO. So it's kind of a little bit of a catch-22. If you're able to get into an IPO, oftentimes it means that every smart money passed up on it. So you got to be careful with that. But let's talk a little bit. You mentioned some of the big price swings that happen. Kind of some examples. Facebook, which is now called Meta, they went public in 2012, and huge expectations for that fund. Yet, shortly after the IPO price, it dropped over 50%. And, it took a few years of recovery. And obviously now, it's one of the largest companies that's in our stock market. It's a big driver of revenue, big driver of share price with our ETFs that we invest in. So, but a huge initial disappointment, about a 50% drawdown. Another example is Uber. It's a good, 2019, it goes starts trading well below the IPO price. It had an extended period of time where investors really were, just struggling to see if they had a path to profitability. And it took a while before it became confident in its long-term purpose and its ability to drive returns. And I think, one final example is Rivian. And, during the electrical vehicle boom that's happened and kind of goes in cycles as well, it was offered, and, good company, just, the share price dropped over 80%. And it's taken a few years, and, just kind of at that level of, kind of building up its business. Now, as it's developed and as the business has matured, you're starting to see it make headways into the EV market. And now you should start to see, possibility of that share price starting to reflect in its ability to dig into that EV market. So, again, I think it's, I always say it's, price is what you pay, value is what you get. And I think that's something when you considering an IPO, I think you need to have a very long-term view on it and realize that maybe the best thing to do is just kind of sit out for a little while and let that trade kind of happen and that movement kind of happen before you jump in. But that's hard to do when we have, our emotions and our behavior settled in. And I know that's what Ethan's going to talk to us about now, is some of those behavioral issues.
Yeah. behavioral finance, and coin it the eighth wonder of the world because there's no blueprint to behavioral finance. Everyone kind of treats things differently. And when we think about IPOs, I'm going to talk a lot about SpaceX. I don't mean to single them out. It's just the most recent one, and it's there's a lot more IPOs that are going to happen over the course of the next 2 to 3 years that are probably going to have a lot of the same characteristics. Just given the AI boom and tech and all those things that are kind of happening in the space, I think we'll just talk about SpaceX because it's just the most recent. So when I think about SpaceX, it IPO'd on June 12th. That was a Friday. Leading up to June 12th, any media outlet that you opened up, any app, news outlet, Yahoo Finance, CNBC, MSNBC, any of those, Financial Times, or any of those magazines, they talked about SpaceX for probably a month to 2 months leading up to that. So there was a lot of hype around it. There was, I remember on local news, I was turning on, KCTV5 here in Kansas City, and the local news was even talking about SpaceX. So it was very, I don't want to say overhyped yet because we don't know, it's very early on, but there was a lot of people talking about it, which brought the herd mentality around that specific IPO. Whether or not it's a good company, we don't know yet. It's good, probably over time, yeah, it's going to be a great company. But people were talking about it so much. I met my neighbor at the mailbox, and I was getting my mail, and we were discussing SpaceX. I mean, everybody was talking about it. It was all over the place. So leading up to that, you think about it, and you think about your own portfolio, and you're like, man, I need to buy some SpaceX because everyone's talking about it. It's going to go to the moon. You just have this preconceived notion on what the stock's going to do, and the reality of the the last 20 IPOs that we could run off, you don't know what's going to happen. Like Jeb said at the beginning, the average drawdown over the first 12 months is about 50 to 55%. So something starts at $100 a share and goes down to $50 a share. It could end the year at $250 a share. You don't know what's going to happen, but people get that fear of missing out mentality, and they want to buy early and they want to buy a lot. And when you think about kind of behavioral finance, when everyone's talking about something, you should be contrarian a little bit and think about it a little harder and just be a little more careful when you're looking to allocate some of your hard-earned retirement dollars or play money, whatever have you, into investment like that. Coming off of the 2020 to 2024 era of investing, there's Robinhood, Wall Street Bets, AMC was a big one, meme coins and Bitcoin and all that stuff, the get rich quick stuff that occurred. You look at people, you hear the stories, hey, I put $100 into this thing and I turned it into 100,000. And that's a great story. And those things are out there, but it's not something that your average investor or your retail investor has access to or is going to get. So thinking about SpaceX and putting dollars to work early is definitely a risk. And when we talk to clients, at the end of the day, if you want to have that in your portfolio, we can get it in there. There's not hesitations or anything like that. But what we want to do is make sure you understand the risks and understand the history of IPOs. And again, not to single out SpaceX, but it's down 25% on the day that we're recording this from the $135 opening price that it had. Shot up to $211. Now it's down to about $114 the last time I looked at it this morning. So you can see, even in the first month of trading, there's extreme amount of volatility that can occur. Now that can taper off towards the end of the year, and it can go up, it can go down. Who knows what that's going to look like. But over time, when these things get hyped up so much, there's a lot that occurs in those first 5 trading days of the IPO that can really determine where that stock's going to go over the next 12 months. And taking a step back, taking that fear of missing out and kind of throwing that to the side and really looking at the company itself, I think is more important than the hype trade or, hey, my neighbor's buying this, I think I should buy it. Or, hey, my dentist told me about this particular stock, I want to buy this. Think about how it fits in your portfolio before you just go and dive all into that. So I think, again, to kind of wrap things up, the behavioral concept or behavioral finance piece of IPOs is very tricky because, like Jeb said, if you're going to buy Amazon on the day it started, it's a great investment, right? But it still took a while for Amazon to shake out the dust to get to that great investment or that great company, if you will. So think about things, slow down, look at history, think about IPOs a little bit more, and then decide from there, hey, does this make sense for my portfolio?
Absolutely. and to piggyback on that, if we're going to take this from a financial planning perspective, right? So if we have a client that comes in and they say, hey, I want to buy this IPO, or I want to buy any stock for that matter, right? I think there's a couple of rule of thumbs from a financial planning perspective that we always want to keep in mind. Okay, number one is, for all of our clients, we've built them a financial plan. And I think we've got to step back and we've got to ask the question, is the amount that we're investing into this company, if it doesn't work out, what does that mean for our financial plan, right? If it doesn't work out, we lose money on this investment. Does this mean that we have to alter our plans, either retire later? We're not going to leave the amount of money we want to our beneficiaries, all those sorts of things. I think that's something that you got to keep in mind. And then I think the other thing is we always want to keep diversification in mind, right? And the reason I say that is, if you think of a mutual fund, a lot of times, many mutual funds don't have any more than, call it 3 to 5% of the money in the mutual fund in any one stock. And I think that's a good thought process for one of our investors too, is just, you don't want any position to be an outweighted or outsized position in your portfolio, because that creates some additional risks, right? So I think from that planning perspective, that's the first thing that we want to do is keep that in mind. So the other thing is I would say being first isn't always the best, right? Being first to the game is not always best. And I'll just give you my own perspective and things that I've done over time, because some of these large names that we've talked about today, I've owned in my portfolio, right? And most of those, I didn't buy all of it at one point in time, right? Most of it over the years, these are companies that I've believed in, that have potential, and waiting for the right time. Like maybe there's some negative news about a company and it gets a 20% pullback, but we know this company's a very quality company that's going to persist, that the economy relies on. Well, maybe that's the time to buy a little bit of a chunk. So you think about dollar cost averaging, and maybe buying small increments at certain times, I think can be a really good way to get invested in a company over time. And what I'll tell you is that if a company is a quality company on the day that it IPOs, it should be a quality company 6 months later, 12 months later, and 18 months later as well. And so just really think about it, instead of the emotions of fear of missing out, of thinking about it of, hey, I want to own this particular company because I believe in it. And let's come up with a smart strategy to get invested in that company, maybe over time, or maybe at a certain price point, or something like that. So, but, other than that, I think always keeping the plan in mind when you're thinking about buying an IPO is important. Just don't do anything that's going to derail the financial plan. And by the way, if you hit a home run, that's awesome. And might you look back and say, God, I wish I would have bought, $100,000 of that instead of $50,000 of that. Yeah, you might do that. But the reality is, what do they say? Base hits win ball games. And sometimes in investing, I think you've got to celebrate the small wins like that, and just try to get as many small wins as you can instead of trying to hit that home run all the time. So, but that's just kind of the thought process from a planning perspective. So, but I'm glad we talked about this today, because I think, number one, we've had a lot of clients calling in asking about IPOs, and I think this is a good way to just kind of talk about them broadly. And so any other closing thoughts, guys?
No, I'd say, don't lose hope on it yet. That like I said, it's only been a month that it's kind of been in the open market or the public market. And like you mentioned, Amazon, it struggled for a little while, but look at it now, right? It's one of the highest weighted positions. So
yeah, I mean, if you would have bought Amazon on the opening day, you would have made your money back in many, many multiples, right? But the problem is what happens is people do that, and then it goes way down, and then they sell it, right? Because they're worried about, they have emotions, they're worried about volatility and all those things. So,
be patient. I think you hit it on the head. It's something that you like. Just be patient with it, and piecemeal it in.
Yeah, the same life lessons I'm trying to teach my 5-year-old now. Tortoise in the hare, right? That they still apply to investing. So.
That's right. So. Awesome. Well, guys, this has been productive, and this is Metcalf Money Moment podcast signing off.
Thanks for tuning in to Metcalf Money Moment, the podcast. We hope today's episode provided valuable insights to help you unlock financial clarity, confidence, and peace of mind. For more expert advice and resources, visit metcalfpartners.com. Until next time. Make every money moment count.
Jeb Graham, Ethan Hutchison, and Eric Wymore are registered representatives with and securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through WCG Wealth Advisors, a registered investment advisor. WCG Wealth Advisors and Metcalf Partners Wealth Management are separate entities from LPL Financial. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.